And to break down all of this and the increasingly interesting state of the global economy, we are joined by Peter Schiff, CEO of Euro Pacific Capital, and Todd Bubba Horwitz, Chief Market Strategist at Bubba Trading. Peter and Todd, this seems to be a moment of high instability and uncertainty, with experts disagreeing on what the numbers we can all see mean and speculating on what numbers are coming to settle some of these arguments about the direction of the economy of China, Germany, the U.S., and the global economy. So I'll just first ask both of you to give us your basic assessment of where those three big economies are right now and where the global economy is heading in this moment. Peter, why don't you go first?
Well, first of all of the rate cuts that your reporter just mentioned globally, they're not going to help the situation. The problem in the global economy is not that interest rates are too high. It's that the amount of debt is too high. And the reason there's so much debt is because central banks have already kept interest rates too low. And lowering them even more doesn't solve the problem. It actually makes the problems bigger because it encourages even more debt. And so this is counterproductive. And I think the U.S. is in the worst shape. I think we are on the verge of finishing the Great Recession that we started in 2008. Only the problems are much larger today than they were then. And I think the back half of this recession is going to be far more severe than the front half.
And Bubba, what's your take on the same question, on the risks of recession in the U.S. and Germany, a big slowdown down in China, and the prognosis for the global economy in 2019 and 2020?
Well, I think that the world economy is obviously in dire straits right now. You can see the rush down to lower rates, as Peter was saying. I think that creates a problem. And of course, there's way too much debt. And I think if China doesn't do something with the trade deal, I think they're going to be in a lot more trouble as well. Of course, it's always hard to get accurate numbers out of China, but they're in trouble as it is. They had troubles before all this started, and they're only going to get worse. But they don't really care about what goes on because they can hold out longer. Here, we've got issues. I think we're in the very early stages of recession here. Now, I'm not as dire on the situation in the United States as Peter is, but I do think that we are going into recession, and I do see a fairly big sell-off coming. Now, again, timing that sell-off, I can never do that, but I can tell you that I would not be surprised to see a 25 to 40% haircut in equities, because right now the Fed continues to kick the can down the road instead of addressing the real problems, letting free markets trade and letting interest rate markets trade where they're supposed to, because if they went to the free market, interest rates would be naturally higher because all these peer-to-peer lenders and everybody else are lending out tons of money, and the banks are just buying those loans from them versus lending to the public. So they're creating a massive amount of high-risk debt, even going to this new 3.5% mortgage again. Have we seen this movie before? So at the end of the day, I think we got troubles. I think a big recession is coming, but I still think that we'll be okay when this is over, and I don't think it's the end of the world. I think it's a natural sell-off from an overbought market that's been totally overvalued with the chase for yield.
So, Peter, we know you love gold, but now we're seeing a kind of a slight rotation out of gold and other safe haven assets after that big knee-jerk reaction on Wednesday last week. It looks like the market has kind of calmed down a bit, and while we know that things aren't great fundamentally, it looks like the investors, in the meantime, are going in a risk-on mode to capture the short-term stimulus boost. So what's your move, and how are you playing this rotation?
Well, I'm not rotating out of gold. In fact, people should be buying more gold on this dip. I think anything below 1,500 now is a good entry point to buy into gold, especially when people realize, or traders, that the only reason that we've saved the market from collapse is because the central banks have capitulated, particularly the Fed. We are now cutting interest rates. We're headed back to zero. They have end quantitative tightening. The next move is back to quantitative easing. This is all designed to help the stock market, but it's going to help gold even more than the stock market, because all the money that they have to print to prop up these stock bubbles is going to be better for gold than it is for stocks. And of course, the stocks that will benefit the most are gold stocks. And so if you want to buy stocks and you're a speculator, that's where you should be looking.
Interesting take, true fundamentalist. So, Bubba, you've seen quite a lot over the years as well, and every single recession we've had, there was actually like a poster child that we kind of blamed it all on. In the 1990s, it was the savings and loan crisis. In the 2000s, it was the dot-com bubble bursting. In 2007, it was the subprime mortgages. So what will the poster child of this one be?
Well, it'll be first the butchering of what's going on with the Federal Reserve. That is first and foremost, because they're always behind the curve and they're trying to react when the horse is already out of the barn. So that will be, I think it'll be another financial. I mean, if you look at the debt structure of what's going on right now, and of course, the United States, Americans are typically a by-the-month society. So as long as they have a job and they can afford to pay for it by the month, they're going to keep buying. Well, who's going to pay for all this debt when we have some slowdown, which we're already starting to see? So I think the Fed, by the way they're acting right now and allowing people to get into a lot of this cheap money or supposedly cheap money, will eventually create the bigger problem. And I agree with Peter, 1,500 in gold is a great level to get in, which is what we've talked about. In fact, I wrote about this morning.
Thanks so much, Peter Schiff and Todd Horwitz. Thank you both for your insight.